Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Okay, let's unpack this.
Right.
Today, we're taking a look into the recent Q2 2025 earnings call from Texas Instruments. And this isn't just about one company's numbers. It's really a fascinating lens into the whole semiconductor industry. Gives us a peek at how a major player like TI is navigating, well, a pretty complex global landscape right now.
Absolutely. And what's fascinating here is how TA's performance, it reflects these much bigger market forces, strategic shifts, stuff that impacts almost every corner of the tech world. So our mission for you today is to go beyond just the raw numbers. We want to really break down the key takeaways from this call. What do they actually mean for the broader economy, for tech trends moving forward? We'll get into those two distinct dynamics management talked about, dive into how key end markets are doing, and see how TI is kind of strategically positioning itself. Some interesting stuff there.
All right, let's kick things off then. Texas Instruments' second quarter for 2025. Let's put it under the microscope. So revenue landed right around where people expected, yeah, about $4.4 billion.
Which is a strong 9% increase from Q1 and a pretty significant 16% jump compared to last year.
That's right, healthy top-line numbers.
But where was the real engine of growth?
Yeah.
Can you sort of peel back the layers for us? Which segments really powered that surge?
Yeah, definitely. The segment growth, it paints a picture of pretty broad-based strength, which
Okay.
is always, a good sign. Their analog revenue, that's a cornerstone for them. It grew by a solid 18% year over year.
18%? Wow.
Yeah. And embedded processing, another core area, saw a robust 10% increase. Even their other segment, which has various specialized products, that was up an impressive 14% from the year before.
So it really does suggest demand isn't just in one little niche.
Exactly. It's spread out. It's a testament to how diverse the applications are for their chips, across so many different industries. Okay, so Q2 looks, on the surface, pretty strong, but management also called out these two distinct dynamics at play. And this is where I think it gets really interesting because they seem to be pulling in different directions almost. First, you've got tariffs and geopolitics just disrupting and reshaping global supply chains. We hear about that all the time. And second, there's the ongoing semiconductor cycle recovery itself. Can you elaborate a bit on that geopolitical aspect? How is that actually influencing demand right now?
It's a critical tension for sure. I mean, look, there's been this temporary pause on semiconductor tariffs between the U.S. and China, but TI's management, they made it really clear they're actively preparing for whatever comes next. Future evolutions, they called it. They're leveraging their flexible global manufacturing to support customers, which gives them a real degree of resilience. But what's really insightful is how customers reacted in Q2. Management saw this potential acceleration of demand, especially from customers who had low inventories. It seems like these customers were keen to build up their stock, probably because of all the noise, the uncertainty around tariffs earlier in the quarter.
Ah, okay. So almost like a reaction, not necessarily pure demand growth.
Kind of. It's almost like, seeing a run on the supermarket shelves because people think a snowstorm is coming. The demand isn't necessarily organic growth. It's more a reaction to maybe future scarcity or higher costs down the line.
That analogy paints a vivid picture. Okay. But then, after what sounds like a strong quarter, analysts picked up on this noticeable tone change from management. Earlier, they sounded pretty confident, but now there seems to be more caution looking ahead to Q3. So what does that imply? How do we balance that genuine underlying cyclical recovery we're hoping for versus this maybe more tariff-driven reactive demand? Is it a real rebound or just a temporary inventory thing?
That's a sharp observation, and it really highlights the challenge, right? Trying to read these complex signals. Management explicitly said part of that Q2 acceleration was likely customers wanting a bit more inventory due to those tariff concerns.
Yeah.
They noted demand sort of normalized through the quarter, which suggests some of that initial surge might have been a bit of a one-time stock-up,
Okay.
not necessarily pure, sustainable end-market demand kicking in fully. Now, the underlying cyclical recovery, they still say it's strong. 4 out of 5 key markets are showing improvement signs. But that noise from tariffs just makes forecasting tricky. It's hard for them to know why customers are ordering only that they are. So their Q3 guidance, it reflects a more, let's say, prudent approach, acknowledging both a recovery and maybe a moderation in that tariff-boosted demand.
Like trying to read the true current when there are strong cross currents from a storm.
Exactly.
Right.
Well put.
Okay, so that brings us to a closer look at where this growth is actually happening. On the ground, so to speak. Beyond the overall numbers, where did the growth really show up across TI's specific end markets in Q2? Let's peel that back.
Right. The end markets give you that granular view, and yeah, there are some interesting divergences.
Hmm.
The industrial market showed really strong performance, increasing upper teens year over year, mid-teens sequentially.
That sounds significant.
It is, and the recovery was broad across all sectors within industrial. It actually accelerated during the quarter, and this is now the third quarter in a row of recovery for industrial. That sector peaked for TI way back in Q3 2022, so it's a sustained rebound.
Okay, third quarter of recovery for industrial. Good sign. And what about the automotive market? That's always a big one. Lots of focus there. What happened in auto?
Yeah, automotive is key. It increased mid-single digits year over year, which is, positive. But interestingly, it actually decreased low single digits sequentially from
Huh.
Q1 to Q2.
Decreased
Right.
sequentially.
Yeah. The recovery in automotive, it's been quite shallow for TI so far. Management suggested it's maybe a year behind the industrial cycle. You've got the OEMs, the tier one suppliers, the car makers, and their direct suppliers.
Yeah.
They're staying cautious. Orders seem to be largely real time. Not much inventory replenishment happening.
So more like a hand-to-mouth approach from auto customers.
Seems like it. Maybe reflecting broader economic worries or just specific challenges within the auto industry itself right now.
Got it. Okay, beyond those two crucial sectors, industrial and auto, where else did they see notable movement in Q2?
Well, personal electronics saw pretty significant growth,
Yeah.
around 25% year over year, upper single digits sequentially. Suggests a continued, maybe slightly moderating, rebound in consumer device demand.
Okay,
Then enterprise systems, this was really impressive, about 40% growth year over year,
10%.
sequentially. Yeah, huge. And it's important to remember this largely includes data centers. Data centers are performing exceptionally well. That's a big future opportunity for TI, especially with things like AI driving demand for specialized chips. And finally, communications equipment grew more than 50% year over year, about 10% sequentially, likely driven by continued infrastructure build-out.
Wow, some really strong numbers in enterprise and comms equipment. Now, turning to regions, China always comes up in these calls, given its importance. What did management say about performance in China specifically, and how might that play into their Q3 caution you mentioned?
Right, China's significant. China-headquartered customers make up about 20% of TI's total revenue.
Mm.
In Q2, China saw strong sequential growth, 19%, and a remarkable year-over-year growth of 32%.
32% year over year in China.
Yeah, with the industrial sector really leading the charge there. Automotive in China, though, behaved pretty similarly to other regions. Didn't show that same strong rebound. Now, management did note that China industrial ran a little hot in Q2, meaning demand was maybe unusually strong, and they think some of that could have been pulled forward because of that tariff noise we talked about,
Ah, so front-loading demand again.
potentially.
Yeah.
And that front-loading is a key reason for their more cautious outlook for Q3. They expect some normalization after that Q2 surge, especially in China industrial.
Okay, that makes sense. So beyond the market performance, let's shift gears to the engine room of the company, the financials. How are things looking there? Profitability, cash flow, are they still generating that impressive cash we usually associate with TI?
Yeah, their financial health looks pretty robust, clearly underpinning those big strategic investments they're making. Gross profit for Q2 was $2.6 billion. That's 58% of revenue. And importantly, that margin was up 110 basis points, so 1.1% sequentially from Q1.
Okay, margin expansion. Good.
Right. Operating profit came in at $1.6 billion, or 35% of revenue, impressively up 25% year over year. Net income was $1.3 billion, which translates to earnings per share, EPS, of $1.41. So yeah, strong indicators of operational efficiency, maybe some pricing power in there too.
And on the capital management side, still strong cash flow, still returning it to shareholders.
Absolutely. They showed strong cash flow from operations, $1.9 billion just in Q2, and a robust $6.4 billion over the last 12 months, the trailing 12 months, or TTM. Now, capital expenditures, CapEx, were $1.3 billion in Q2. They're definitely continuing to invest heavily in manufacturing.
Right, that's their big strategic push.
Exactly. Their free cash flow on that trailing 12-month basis stood at $1.8 billion, and they're actively returning value. They returned $6.7 billion to owners in the past year, mostly through dividends, about $1.2 billion there, and stock repurchases, around $302 million. The balance sheet looks healthy, too. $5.4 billion in cash. Inventory was $4.8 billion. Days of inventory came down slightly to 231 days. So the team well-positioned, not overstocked, but ready for demand.
Okay, so bringing all this together then, What does the company actually expect for the next quarter, Q3? What's the guidance telling us about their near-term confidence?
Right, the outlook. For Q3 2025, TI anticipates revenue to be in the range of $4.45 billion to $4.80 billion. And earnings per share, EPS, expected between $1.36 and $1.60. Now, interestingly, they also foresee gross margins being about flat sequentially, even with potentially higher revenue at the midpoint.
Flat margins even with higher revenue. Why is that?
Well, it's primarily due to increased depreciation hitting the books from all those massive capital investments starting to come online, and also an unfavorable net interest expense impact. So while the top line might grow, profitability gets a bit of pressure from these big long-term strategic outlays starting to depreciate.
Makes sense. And speaking of those long-term outlays, CapEx has been such a huge topic for TI, this focus on domestic manufacturing, building resilience. Any updates on those ambitious plans? Did they change anything?
Nope, no changes there, which really signals their unwavering commitment to that strategy. They reiterated their CapEx guidance. $5 billion for this year, 2025, and then a range of $2 billion to $5 billion for 2026, depending on revenue and growth expectations when we get closer to that time. Depreciation forecasts are also consistent, $1.8 to $2 billion for 2025, $2.3 to $2.7 billion for 2026. It just clearly signals continued significant investment in expanding and modernizing their manufacturing. It's a core part of their strategy, really sets them apart.
And there was another fascinating, very recent development they touched on. New U.S. tax legislation just passed. How does that impact TI's financial picture, their strategy? This feels like it could be a pretty big deal.
Oh, it is. This legislation looks like a significant positive for TI. It should directly boost their financial flexibility. It includes some really favorable provisions, like the immediate expensing of U.S. R&D costs, and eligible capital expenditures, too. Plus, an increase to the investment tax credit, the ITC, from 25% up to 35%.
35% ITC, wow.
Yeah, that's substantial. Now, they're still evaluating the full impact, figuring out all the details. They expect their JAP tax rates, that's the official accounting rate, to actually increase in Q3 2025.
Yeah.
But then decrease in 2026 and beyond. But crucially, they anticipate significantly lower cash tax rates for several years.
Lower cash taxes, that's the key for free cash flow, right?
Exactly. It directly benefits their free cash flow generation. And, notably, they said this doesn't change their CapEx plans.
Yeah.
So the tax benefits basically amplify their existing strategy. They don't change its course. It just makes what they were already doing even more financially attractive.
That's a powerful tailwind then. So pulling it all together, what's the long-term strategic advantage they're really trying to build here with all these investments, the focus on U.S. manufacturing, their market position? What's the big picture for TI?
Look, TI is really focused on strengthening what they see as their core competitive advantages. That includes leading in manufacturing and technology, maintaining that broad, diverse product portfolio, expanding their channel reach, and securing these diverse, long-lived positions in various markets. Chips that stay in products for years and years. Their growing U.S. manufacturing footprint is absolutely a cornerstone of this. It provides what they call geopolitically dependable capacity.
Geopolitically dependable capacity. That phrase says a lot.
It does. And they emphasize they've been building this unique position over the past 5 years. It wasn't just a reaction to recent tariffs. They genuinely believe this whole situation presents an opportunity that's actually greater than their challenge, especially if U.S.-made semiconductors get further incentive down the road. It's really a proactive play for strategic dominance. It gives them a unique, cost-effective solution at scale in a world that's increasingly valuing supply chain resilience and geographic stability.
So what does this all mean for you, the listener? TI's strategy clearly emphasizes long-term free cash flow per share growth. They're leveraging their deep engineering core and tech foundation to adapt, maybe even thrive, in this dynamic global market. It really feels like a blueprint for resilience and maybe sustained advantage.
I think that's right. And the ongoing interplay, that tension between the underlying semiconductor cycle recovery, which seems to be firming up, and this persistent noise from geopolitics and tariffs, it just highlights how complex global supply chains are right now. So here's something to consider. While the semiconductor cycle looks like it's improving across most markets, industrial, enterprise, comms are strong, these lingering effects of geopolitical shifts could keep creating unexpected bumps in demand, fluctuations. It just makes it absolutely crucial for companies like TI to remain incredibly flexible. And for their customers, for you perhaps, to think deeply not just about the cost of the components, but about the geographic dependability, the resilience of your supply chains in what feels like an ever more unpredictable world.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.